Welcome to the MHP Exchange, where the riches are in the niches. We'll show you how to invest your way into mobile home parks with real strategies, tips, and behind-the-scenes know-how to grow your cash flow. Stick around. This is where smart investing begins.
Manufactured housing is at an inflection point right now. And regulation isn't coming because the math stopped working. It's coming because there's operators who have broke trust. And bad operators have entered the space with a single thesis. We can raise rents without earning it, without justifying the value that we're creating, and without the understanding to the underlying communities and treating it like a commodity, not the people there and who it's going to impact. Very few people in this industry are able or willing to talk about that out loud. Today's guest does. He's Andrew Cramer from Bridgeview Asset Management, and he's been in the manufactured housing space since 2011. He's owned, operated over 3,100 lots. And I believe, Andrew, something in the neighborhood of about $600 million of real estate transactions you've been involved in.
Yeah, if you throw it all together, it's probably something like that. But yeah.
Right now, he manages a portfolio of over 1,500 lots in the Pacific Northwest, which is probably outside of the Northeast, the two most regulated areas in the country. And he's our guest today. And we're going to talk about responsibility. We're going to talk about optics, and we're going to talk about the state of affordable housing. We might even find out a little bit more about Bridgeview today, right? So, Andrew, thank you so much for being part of the program.
Thanks, Frank. Thanks for having me. Looking forward to this.
Andrew, anybody who follows your articles that you write on LinkedIn or has heard you speak, I mean, one of the things that really set you apart from a lot of other operators in the space is that you're willing to articulate the uncomfortable truth out loud. So why don't you give us a little bit about like where you see or the biggest issue that you're seeing right now in the manufactured housing space?
Yeah, thanks. Thanks again, Frank. I mean, I think I can speak, as you mentioned, largely to the Pacific Northwest. From your previous comment, I think we certainly have to throw in California as a highly regulated place too. But the Pacific Northwest is certainly one of them, and the difference is it's been rather sudden. Oregon passed statewide rent control in 2019. Washington just passed it in this past legislative session in 2025. So it's been a lot very recently. One of the reasons for that is kind of, as you're alluding to, it was sort of, I think that the regulatory actions that happen really in any market are always fundamentally going to be an overcorrection, because that's what government does. Government will step in, see a problem. They have 180 days to come up with a solution. And these guys fundamentally are operating on an electoral cycle. So they're going to say, what can I do right now? And I'm not going to be critical of elected officials here. I'm just speaking what they have to do, which is they have to get reelected. That's kind of part of their job, to stay in office so that they can serve their constituents. And when you look at something like housing or construction, which is much longer than an electoral term of 2 years or 4 years, this is why you start to see these massive disconnects. Something like rent control that has a huge amount of ramifications. And I've, as you mentioned, I've kind of written about this extensively. But to kind of get back to your initial question, the biggest challenge in the Northwest by far facing manufactured housing is going to be this confluence of regulatory burden, regulatory changes, really in response to what someone who's not an expert or operating in manufactured housing or multifamily housing sees as a massive discrepancy in power and parity, where they're seeing, if you're looking at it from the outside, you see giant private equity companies buying parks where very, very low income people live, and increasing the cost of housing, like for however you want to articulate that specifically. But that's what's happening. They're saying, hey, these giant multinational companies are showing up. They're buying these properties. They're increasing rent. they're making tons of money because they have government subsidized loans and they're able to do all these things, and they're operating these properties and they're not investing in the properties and they're making massive profits. And on its surface, that's all kind of true, right? Like that is happening. The problem is you then lump everyone into that same category. And ironically, one of the things I find with this high regulatory burden, the sort of disreputable operators are unfortunately the ones who do the best, right? Because they're the ones who will show up, they'll double rents, they'll not invest in the property, and then suddenly when rent control shows up, well, they've got the highest rents, and they now, you know, they've created, it's a very odd, ironic consequence of high regulation, is that you end up seeing these bad behaviors that you wanted to eliminate. Those are ironically rewarded because now you've got the high, you know, the properties with the highest rents, thus the highest income, are going to be valued higher than anyone who is trying to operate in a little bit more of a, you know, ethical manner, right? So I think that's kind of one of the things I see as challenging, because you can't, you have to figure out how do you, in this, now this increased regulatory environment, how do you kind of, how do you make sense of that, and then how do you continue to operate in what I feel is sort of a necessary ethical manner. So I think that's kind of, you know, that the biggest challenge I see, as you mentioned, is kind of there's going to be increased regulatory burden. That's a reality. And then how do we, now that we've sort of crossed this hurdle, this big terrifying rent control hurdle, how do we now continue to operate in a way that makes sense for our investors, but is also going to continue to be, you know, ethical and responsible, and sort of, you know, work with, as much as I can, as much as we can, the greater sort of public body, the elected community, and say, hey guys, you know, this is like, let's try and get into the minutia here so that we're not all getting lumped in with one group, and sort of and trying to figure out how do we kind of have a little more breadth and latitude to operate. So I think that's going to be a big one for the next probably 10 or 15 years, is sort of operating in that regulatory scrutiny.
Yeah, you know, and that's one of the challenges, because listen, rent increases are part of the business, right? Like but what in your mind like crosses the line from a bad operator to maybe just bad optics? Like
Yeah.
you know, what takes an operator in your mind from just a bad actor to just bad optics?
Yeah, and that happens a lot. Not, you know, I can give you, there's some, you know, Washington has very specific rules around, without getting into too many details, the anniversary date of a rent increase, right? So it has to be on the month you move in. And there have been some very landmark cases, which you know, you guys can look up. But there have been some operators who have been fined millions of dollars, really based around just the fact that they weren't issuing the increase on the correct month. And so, you know, that's kind of one of those things where you think, man, that doesn't seem like that should merit such a massive fine. And so you kind of look at that on the surface and say, well, whoa, whoa, wait a minute, that's not right. But then you kind of, if you dig in a little bit, and, you know, I know the operators who are being fined, and it's an interesting, for me, a bit of an interesting case study, because one of them I don't think is a particularly unethical person. And the other one is definitely an unethical person. But this is a great example of how oversight is going to hit everybody the same way. And, you know, Nick Brown, the Attorney General in Washington, is not a stupid guy. And he sort of found this very easy to legislate, because it was so clear cut in the revised code of Washington that you cannot do these increases outside of the month of move-in. Nick Brown said, well, we don't like these guys, and now this is a very, very easy way within the confines of state law that we can go after them. So I think that's an example of how, you know, two operators, one very unethical, one, you know, aggressive, but again, I don't think he was an unethical guy, but getting hit in the exact same way. So I think that's just quickly kind of like, this is what happens when you let sort of big regulatory bodies handle things. Everybody kind of getting painted with the same brush. That's what's going to happen. To me, the difference between ethical and unethical operations is quite simply just not taking into account the needs of the community. I personally think that rent increases can make things better, because you're increasing the revenue of that property, and you kind of need to do that. And I mean, you know, talking to any resident of any community, if you're living somewhere that's safe, that has reliable utilities, that's secure, that your kids can play in, that have, you know, all of these things that are just necessary, and if you're going to pay more for that versus not having any of that, I can't think of anyone who's not going to want that higher quality of life. Another side of that is how do you, so I think ethical operations also involves how do you increase, revenue for investors, but also increase quality of life. And, there's a couple examples I love are things like locking mailboxes, which I'm sure, Frank, you install those. They're not that expensive in the scheme of things, but in terms of quality of life increase, particularly in like a senior 55 and over park, where you have a lot of older people who are receiving medication, social security checks, ripe for theft. And if you go from an unsecured mail system to a secured mail system, your tenant's quality of life just went way up. And in a 100-unit park, to add locking mailboxes might cost 25 grand, right? In the scheme of things, a very low investment, but from a quality of life standpoint, vastly increases the quality of life for your tenant. So it doesn't have to be dollar for dollar. You just have to be thoughtful. And I think, to me, the difference is if you're not thoughtful about that and you buy a property, you just say, hey, how much can I crank these rents up? That once you're down that path, it's really hard to step off of that path and get back into a mentality of how do I improve quality of life? Because I found, honestly, almost invariably, it is never a linear connection, dollars spent to quality of life increase. It's always some version of that locking mailbox analogy, right? Like seal coating and restriping roads isn't that expensive, but it is transformative for people living in a park. And it also, these things compound and stack on one another, right? If you go in and start, we love doing that when you buy a property, you start instantly making a lot of cosmetic improvements, because what you see is, because again, we're not the only owners in manufactured home communities. We have a bunch of residents who own their homes, and when they see that investment, they start investing in their own homes. And that's that compounding effect where now, and I've seen that so many times, where you can buy a park that's very distressed and you're not putting all the money in because you're investing in the infrastructure and updating the common areas, and then your tenants start to follow suit. And before you know it, you've got this beautiful agency qualified property that you have not really had this, the dollars spent are vastly versus the quality of life. The quality of life is vastly superseded by the dollars spent. So, or it's way, you don't have to invest dollar for dollar, I guess, if that makes sense. And that, to me, is like the core tenet of ethical operations, is just thinking about that. Doesn't mean you can't make money. Doesn't mean you can't have these be fantastic investments, but you got to think about that. And when you don't, I think that's when you start to see this regulatory overcorrection.
I think what you say there, and we do such a, in real estate in general, right? So I'm not going to just say MHP as a standalone, but in real estate in general, I think a lot of times we do a poor job of controlling the narrative, because it's easy to say, hey, look at how much, here's my win. Look how much money I generated, or the return that I generated for the investors. And to your point, if you don't talk about the impact that you're making on the investment and where
Right.
you're really where that you're really making that change, then it just looks like it's dollar driven. And of course,
Yeah.
the response is going to be you're making too much, right?
Yep.
In many cases, right? People aren't talking about, and now there are some operators that are doing nothing, right, and just completely looking at it as a rent play or an income play. But there are people out there who are focused, like the infrastructure improvements cost money. I mean, you're acquiring some of these parks that might be 40, 50 years old. There's underlying issues that the legacy owner hasn't been able to address because their lot rents were so far below, and it was a income stream rather than an investment.
Right.
You're making those infrastructure improvements. You're impacting the quality of life, and you're working to provide an affordable housing need inside that community as a whole, and that drives value, right? And we're not sharing that enough. And then it's easy to say, well, the politics get blamed. Like, all right, these legislators are just, and this is not a red blue thing. It's just, this is what happens, right?
Yeah.
So I think we have to do a better job of explaining, like, hey, what are you doing to build culture inside your community? How are we making that impact down there?
Yeah. And to add on that, I think that's also, people don't want to fix what's not broken, right? And I think there's in the evolution of, I think manufactured housing, we're in the industry and we think about it all the time, but like it's a very small part of multifamily housing. It's less than 1%, but And I think one of the things that's changed, you know, in the limited amount of time I've been involved in this is the sort of the 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 generation of investors sort of preceding didn't really have to do much, mainly because it wasn't really a legitimate asset class for a long time, right? You could buy, it was sort of this weird offshoot, and there was financing, but not really. And there was certainly no institutional investment in the space. And when you've got a park where you can buy it for $100, you know, those spaces are $100 a month, and apartments in the area are renting for $700 a month. Well, if you increase the rents to $300 a month, no one's really going to raise any flags, right? Just because it's such a, in the scheme of things, it's a small part of the market, and you're still very, very affordable. And so I think the industry and the investors got a little bit lazy just because you could triple your rents and nobody cared. You know, there was no regulation, there was no nothing. But then that attitude very quickly caught up to market, right? Where now suddenly, if you're buying that same park and the rents are $850 a month and the corresponding apartment rent is $1,200 a month, there's really not a lot of room there anymore, right? But the mentality and the strategy didn't change, and that's when suddenly you started to see these issues. And you kind of like we sort of create our own problem too, right? Because now from a legislative standpoint, take a 100-unit apartment building versus a 100-unit mobile home park. 100-unit mobile home park, those tenants are staying in one place much longer than your, you know, apartment average turnover is 35%, at least in the Northwest. Mobile home parks, depending on the park, it's usually less than 10, usually less than 5%. So if you're a legislator and you're a state elected official, you know, those 250 people living in that 100-unit park, they can keep you in office forever if you kind of maintain a good relationship with them and you sort of are you're viewed by them as working for them. So I think inadvertently, by bringing all this scrutiny to the manufactured housing industry, the legislators have found this gold mine of loyal voters. I think that's the other side of it that I've noticed recently, is that rather than go after apartment dwellers, we're going to move all the time, and they tend to be younger. They're not really voters, contrasted with a manufactured home resident who stays in one place, who is a little bit older, who is very politically involved because they have to be. I think that's another interesting change that's happened as a result of sort of the increased scrutiny.
Now, you mentioned something about the older mobile home park operators, and not to date you, right? But you've actually been involved in the MHP space since 2011, which nowadays
that makes
it's
me
almost
older,
like
doesn't it?
Yeah, well, it's like 2 generations of ownership that have happened, right? Maybe 3, right?
Yeah,
So
but
you've
you're
kind
right.
of, right?
It's sad but true.
So in that time, like, do you see where how you're handling that component of it? Like, do you spend more time looking at the optics? Like, how are we going to address these issues going through?
I think, you know, and I'm not trying to pat myself on the back. I always did. I always had this. I don't know why, but I always had a very sort of, I had a paranoia about government oversight. And I was always worried that like there was a code inspector looking over my back, and like anything I did that was at all untoward would be immediately jumped upon. So things like rent increases, I was always very thoughtful about, and I was always very conscious of market rents, even in the pre-rent control era. And like I said, I wasn't like up on some ethical high horse. I always had a weird feeling, which, you know, and you could argue put me at a disadvantage, right? Because like what I should have done is just cranked rents up, and then rent control shows up, and so I think the difference now, I sort of, we're all like, I'm always looking. It's kind of like we talked about earlier. It's about how do you figure out ways to increase value, and there are many ways to do that. And the one we've talked about a lot is raising rents, right? Going from $700 a month to $800 a month increases the value of the property. That it's the irony of rent control is it takes that away as a risk. Where now, you know, whatever the rent control amount is, that you can very accurately predict your revenue in a rent controlled environment, because like rents don't really go down in a rent controlled environment. I mean, we're going to go with the examples we have. Those markets you mentioned at the start, all of those are extraordinarily difficult to build into, right? New York, California, the Northwest, extremely difficult to add supply. So now you've got a very restricted supply environment. You've got a very restricted revenue environment. So that just creates a very reliable, predictable revenue increase. But it's also limited. And so when you're talking about adding value, you have to start going into other things. One of the beautiful things in my mind of manufactured housing is these properties are usually old, like you mentioned, 40, 50 years old. And I've seen countless times where you have an older owner. I'm walking a park with a guy who's owned the park, who's in his 80s, and he points to a section, and I say, "What's that?" And he goes, "That's the old RV section. I don't use that anymore." And now suddenly, the 40 unit park you're looking at suddenly becomes a 60 unit park because and that the big thing to me is that's approved, right? There's a big difference between having an acre of land versus having something that used to be an RV section or that used to be something else. Because now when you go to the city and county, you say, "Hey guys, here's a bunch of old, it's a bunch of rusted out galvanized, it's a bunch of just beat to, it's a bunch of old exposed wire electric, but it's there." And now that's a totally different world. So value creation becomes a little bit more, it's definitely more creative, and it's also, it's a little more involved, but it's very much there
You-
in this industry. And that's one of the things we love to find. So yeah, like I think that's,
you-
to answer your question, like we've always done that, but now it's just very much more deliberate.
Yeah,
Making
I think for us, one of the things that we looked at was, hey, if we're looking at the opportunity, we I didn't think as a value add investor, just because we put our name on the title, right, of the property, that all of a sudden we created value. And if
right.
somebody was living in maybe a community that we thought was substandard because the roads weren't there, maybe it was dangerous, the trees were a hazard, or the infrastructure wasn't set up, it was poorly lit, maybe there was a crime problem.
Yeah.
Just because we're there and we say, hey, we need to bump rents, that doesn't necessarily justify it.
Right.
But if we could show first and foremost, hey, these are the improvements that we made, and now
Hmm.
we tried to guide, rents closer to market, lot less pushback because they've gotten some. And then we would
Yeah.
see
Oh, for
that
sure.
as you raise standards, I don't know, maybe you could, as we started to raise standards and enforce culture, you're going to get a natural transition of, 20-25%, because there's
Hmm.
people who are there just because it's low and no one's paying attention, and it doesn't matter what their lot looks like, and it doesn't matter what they do. But once that stuff matters, well, then you get the attrition, and you could create value there. And then obviously infill, there's your additional. So,
That's
but you
right.
have to set it goes back to you as an operator setting the expectation for your capital partners too. Like, hey,
Yeah.
we're not going to go in there and you know let it rip day one. But if this works, it works. 6 months, 12 months, 18 months down the road, and you've got to kind of believe in that plan and that
Yeah.
vision for the community.
100%. Yeah. It's funny. I always think when you're talking about like the natural turnover, when appropriate management shows up, I always say like, I've yet to meet the criminal mastermind. I've dealt with many people doing illegal things, but the one trait they all share is laziness. And just as you said, when you start to enforce things, 95% of those people just leave because it's no longer low hanging fruit, right? If you're going to be involved in drugs, if you're going to be involved in like something abusive, and suddenly there's people paying attention, like I said, I've never had like an Alamo stand where like guys are kicking out windows and shooting at me with shotguns. Like they don't want to be there anymore because it's no longer easy. And you're absolutely right. When you go into a property and all you're doing is just showing up and being there every day and saying, this is, we're going to be here now, and we're going to be making sure that this place is safe, and we're going to be investing. Sometimes just that creates a massive amount of value because the right people who live there are now saying, all right, these guys seem to be serious. And if you got to back it up, obviously, but now you're going to start to see that, yeah, that transition of where you're getting, now you have a financial advantage of getting to turn over units to a market rent. You have a community advantage of getting rid of people who were not beneficial to the community. And that's, again, those sort of those compounding elements. And oftentimes we see, particularly like in more rural locations, you've got these great like family expansions that happen where you have a family that might have multiple generations in one unit, right? And now, when you start to increase the density or you start to add infill units, like that same family just starts to expand. You have this amazing impact of, you've already sort of underwritten these tenants, they're kind of already there, but now they're in more units, and so like you've actually increased their quality of life. So I think we love seeing things like that. But yeah, I think it's very much um, you just kind of have to take a very, very deliberate look at what is the value you're adding to this property. And when you, and that, we're talking a lot about sort of like community impact and working within the regulatory environment. But like all of this has tremendous investment value too, because you're not like looking at the hard numbers of it. You don't have to spend 2x your acquisition cost to get 2x your value back, not even close. And
Correct.
I think as long as you're doing it the right way, and then kind of the other side of this is when you start to foster that relationship you mentioned with your tenants, and you're actually creating value and you're improving life, the stability of that community goes way up too, and the ability, just again think about the economics, absorbing those long-term rent increases becomes a non-issue, because there's no longer, everybody kind of understands what's happening. And when you can, one of the things you can really do is provide stability. And stability is many things in a housing sense, but the main one to me is like, can you keep that community affordable? Can you keep it clean? And can you keep it safe? And when you do those three things, it's not that, it's amazing how often people try and do more than that, and it's amazing how often people try and do less than that. But when you stay within that band, it really, that's our main focus, is trying to just kind of maintain our communities in that clean, safe, affordable context. And that's what people want. And if you're trying to do more than that, the expectations, and if you're trying to raise rents based on something other than those three things, you're going to get yourself in trouble. And then obviously if you do less than that, well, then there's all kinds of problems that ensue.
You define it so well, right, in terms of where the focus needs to be. When you look at the overall state of affordable housing in this country, and look, I travel a lot, mainly from the Northeast all the way down to the Southeast, where we're focused. But from your perspective, affordable housing is an issue everybody I speak to across the country, every community is having it. Like, where do you see manufactured housing's role in there, and some of the offshoots that we have in manufactured housing?
Yeah.
How do you see that addressing some of these issues going forward?
I think there's so many layers of affordable housing, and I think it's a very there's too many perspectives to consider. And I think that's why, when kind of get back to sort of the government has to take everybody's perspective, right? They have to listen to everybody, and when that happens, absolutely nothing gets done. Because when you're talking about how do you deliver housing to a market where the sort of base wages can't afford the real estate, right? That's kind of the definition of affordable housing. Happens in New York, happens in Seattle, happens in Portland. And there's a lot of, how do you address that? Well, do you raise wages? Well, you kind of can, and we've seen that in the Northwest and in New York, where you increase the minimum wage. And I don't want this to be political, but what also happens when you do that is the cost of goods increase. And so now, yeah, you've increased the minimum wage, but everything else went up too. So that doesn't really work. And then we talked about rent control. Well, what does rent control really do? Well, and I, again, only speak to the examples we have. It constricts supply, and it reduces capital investment, because now if you're a multifamily home builder, or if you're looking to buy an asset in a given market, your thoughts and underwriting change. And let's just sort of leave it at that. And so when you're talking about how do you deliver more affordable housing, well, you have to be able to get to a point where the units that you're bringing in are going to be within that same band, clean, safe, affordable, but also delivered at a price point that can sort of make sense. And so, like, to bring this back to manufactured housing, unequivocally, it is the least expensive means to deliver housing to a market, unarguable, in my opinion. There's just no, I mean, look in the Northwest, affordable units cost $350,000 a unit to build. Manufactured housing is less than half that, usually a third of that. So I think it definitely has a place. It needs to have a place in the affordable housing conversation. I feel like it doesn't. That's largely just because of the existing stigma of mobile homes. And we can get, like, I've written a bunch of stuff about that, but I mean, really it just comes back to a stigma that never really went away. A stigma of sort of the pre-HUD era, when there was very few regulations to the industry. But ironically, those have really stuck with it. And so now if you want to do, I mean, just 2 years ago, manufactured homes became FHA eligible, which is insane. And now, like, it's there's not a lot of mortgage brokers that are doing it. So it's great, but also like, oh man, how long is this going to really take before, someone can put 3.5% down? to buy a manufactured home. You can do it, but like I said, there's only like in California, there's one mortgage broker. There's none in the Northwest. I can't speak to the Northeast, but I imagine it's similar.
Sure.
So I think so the role of manufactured housing is going to have to be there's a couple ways to do it. I mean, one is like we're talking about here, right? You find existing manufactured home parks where the stigma's kind of already there, and you add infill units. I think that's a tremendous opportunity. I just did a little bit of research in the greater Portland area. There's something like 1,300 vacant manufactured home lots in existing parks. That is so easy. Work with those owners, bring units to those vacant lots. Everything's already there. No land use, no nothing. That's a great thing to do. Most communities have some version of that, right? Where you've got existing parks with vacancy, and that's
but have you run into issues? So when you take that point where like you have a park that has vacant lots, then you go to the city, you go to the county, and even though they have an affordability issue, they don't want you bringing in a home, or they want you to bring in a very specific. Like, have you ran across that?
all the time. And the one of the second park I bought, it was in a little community in Western Washington. I still own properties there, so I won't name it because I don't want them to get mad at me. But they had a law on their city. They had a city ordinance that you couldn't bring in a mobile home that's more than 2 years old, which is in a market that's small and growing. It was unaffordable. So yeah, I mean, I had to take them to a state legislation, or I had to take them to sort of a state hearing and make them change their code. But so yeah, that happens all the time, where it's either they don't want it or they say this is bad. And not to kind of keep bending back to the regulatory side of things, but that also unfortunately makes sense, right? Because you have a 100-unit mobile home park, the assessed value of that property versus a 100-unit subdivision is what, 5% from a property tax revenue standpoint, because you've got a bunch of personal property sitting on top of real property. Whereas if it's a 100-lot subdivision that that one of these big home builders built, now you've got the entire taxable value of that entire structure. So I think if you're a city and you're looking at tax revenue, mobile home parks aren't great, just fundamentally, because if you'd rather not have that park there, you'd rather have houses there because of your tax revenue is so much higher. So like they're kind of like they have a little bit of a optics problem because they need to generate revenue over here and they need to provide housing over here, but they also have a bunch of affordable properties within their city limits that they kind of want to keep. They want to talk about keeping, but just as you said, they really don't. But I understand that. I mean, I think they have there's unfortunately they do have this like bipolar attitude towards manufactured housing. Yes, it's affordable, but it also doesn't do a lot for their property tax base. And that's kind of why they also like these big, expensive, affordable apartment buildings for the same reason. They generate a lot of tax revenue. So I think um, it's gonna involve a lot of working around conventional construction and conventional home building. And I think existing parks are a great example of that. Another interesting one that we're just exploring now is kind of that conversion of what was formerly like a recreational RV campground park type of property and converting that into more of a long-term property. And that's via the use of things like park model homes, which real quick are just things that look like mobile homes but are built to the RV code and thus can go on RV lots. That's a great way to add a bunch of long-term affordable housing, again using the same infrastructure. So I think manufactured housing uniquely can repurpose existing infrastructure. You can't just an apartment building is always going to be there. You can't pick up that apartment building and put a new one down. Whereas with manufactured housing, we kind of can. You can take like an old RV park with 30 amp power and septic and all these other sort of older utility connections. You can do fundamental upgrades of them, and then you can turn that into a long-term community. And that
But
adds a bunch of
you've done a you and I'm not the kid, but you've done a park model community before, right? Like you've
many.
actually, you're not
Yeah.
just and how was that transition? Like, how did you see the market respond to that? Because we've looked at it
Hmm.
and I've seen that, listen, people have a different look at the park model house, right? Or the
Hmm.
tiny home than they do
Sure.
the mobile home. The price could be the same. The manufactured home could be bigger, but they'd rather have the tiny home. I mean,
Hmm.
and it's just from a value perspective, you might say, like, that doesn't make sense, but it's just the market accepts it different. Is that what you've seen?
Very much so, yeah. And I think you have to it's also an element of figuring out you know, just like just like any business, right? Like, who is your market? Market to someone very specifically. That the park model, if you are very specifically targeting an affordable demographic, and you're talking about this unit not as like, hey guys, I'm really sorry that this is kind of built to an RV thing and it's weird, and versus saying, hey, your choices are 1,500 bucks a month for this one bedroom apartment where you share all your walls and you have to pay extra for parking and every dollar of rent you never see again, versus this really cool new structure that's got 2 bedrooms. Yeah, one's a loft, but so what? And by the way, half your rent is going towards paying a mortgage, and you have your own parking and you don't share any walls. Like, just the conversation, if you can target that conversation in the right way, it's a totally different thing. And I think that's what we found a lot, like when you're talking about like RV to park model conversions, we've had a lot of success with that, with really marketing to that young couple looking for an apartment, or targeting and finding that affordability level of like, all right, and that's what we always look at, is like, what is that 2 bedroom or even 1 bedroom apartment rent? That's our target for like a space rent plus utilities plus a mortgage on that mobile home or park model home. And when you target your marketing that way, you know, it matters way less what the structure is, because you are absolutely right. If you're going after like the tiny home guys, like these super cool tiny homes that are like built one off and custom, they're beautiful and they're super cool and they cost $185,000, versus like a Clayton Park model that I can deliver at my park and sell to a tenant for $90,000. It's not going to be the same. But again, that's making sure that you're targeting the right people. I think there might be, and I've seen it, there's been some really, really cool projects in the Southeast in Texas where they have done like tiny home communities. Um, it's not, I don't think it's really the business I'm in, which is not to say it could have tremendous impact. And I've done a lot. I've built my own tiny homes. We've worked with lots of different builders. And that's kind of, so there's great opportunity there. And there's lots, I can get into lots of details about tiny homes. But I think it's, from an affordability standpoint, again, just finding the right people, reaching the right people who really need that affordable product. Oftentimes, face it, like, if you're a retiree and you have $200,000 to spend on a gorgeous tiny home, God bless you, but you don't really need affordable housing. Like, that's a lifestyle thing, which is fine. Don't get me wrong. But that's just not, we trying to market to those people is going to fundamentally take you out of the affordable housing market, in my opinion.
Sure. I want to talk briefly a little bit about you and how Bridgeview is funding these deals, because you've gone through this entire cycle, right? 15 years in the space, starting your first deal, putting your own money in, right? That I know a little bit about. Andrew's first deal he did himself, right? But you've raised capital, you've worked with hedge funds. Now, like, how do you stack your capital now? Do you have a fund? Do you syndicate? Do you work with private equity? Like, how are you? Because the question is, there's a lot of operators out there looking for different sources of capital.
Yeah.
I mean, where do you align this, and what do you think works best with your vision?
I've done all of it. You're right. And our most recent iteration is just that good old-fashioned syndication, which is not to say, I mean, like, we do work with family offices. So like we'll work with sort of like larger capital providers, if that's what you want to call it. Uh, I think the having an opportunity to sort of speak in general about sort of investment, having
Sure.
an opportunity to talk directly to the people whose money it is, I think is really important. Because if you don't have that, if I can't talk to you and say like, hey, Frank's an accredited investor and he's looking to put $100,000 or $50,000 into his first real estate investment to build wealth for his family, like, I want to talk to you. I don't want you to bounce that up to your family office advisor, who then bounces it to someone else, because the ability for me to compete with the breadth of every opportunity out there is much, much harder. I've found it, it's not impossible, but then you're talking about things that get very narrow. You're talking about IRR, you're talking about return on investment, you're talking about 5-year exits and all these other things that fund structures require. If you can talk to people directly, they start to understand the things we're talking about, right? So not even from an investment standpoint, but if you can generate great returns, and if you're living in Seattle and you drive to work and you see, 9 homeless tents going past you, you're like, man, not only do I want to do something about this, but like this will make my life better if I can do something that solves this problem without completely outside of sort of government interactions. And we can talk forever about that too, but I think it's more important just to think one of the things we provide as manufactured housing is an unsubsidized resource for affordable housing, right? For the most part. And I think people really like that. And they say, if I can directly impact my community and also generate great returns, uh, that's just in the last probably year or two, we've really focused on just getting right down to the individual investor. And I think that's number one, way more fulfilling, I think, for both sides to have those conversations and say like, hey, this is what we do. Yes, we can generate these returns, but here's what you're going to be investing in. And I think that's been really enjoyable, which is, so I think I'm hoping, just like the rest, every other person on the planet, that there's some miracle family office that gets this and wants to just back every deal we do. And maybe that'll show up. But I think it's actually, that's I still find that like yes, the syndicated structure is very, it's a little bit cumbersome on the front end to sort of raise the money per deal. And that I think but I think to me the trade-offs of getting to have those conversations, talk about this is where your money's going, that's been worth it, versus like the fund opportunities we've sort of passed on ultimately. So yeah, I think the capital side of it is very important, and it can really be meaningful and impactful to all the things we're talking about too, right? Because like the other side of this, you've already spoken to it, is this takes a while, right? Like digging up those old RV sites and running new utilities and upgrading power and adding meters and it takes a while. And oftentimes that first year, you're not seeing any distributions. Often the first 2 years, you're not seeing any distributions. When you do it this way, you have to build something, and really having people who understand that, aren't showing up in like quarter 5 and saying, hey, we need to sell everything, we're closing the fund. Like that's important too.
Yeah, it's funny because you mentioned that this will take a while, and I would look at you and Bridgeview as an institutional investor, right? For in this asset class, right? Like but you buy non-institutional assets. Like you're
All the
still
time.
rolling up, you're still rolling up your sleeves and getting dirty, like traditional value add. Like what are you typically looking at, or Bridgeview typically looking at when you're like, what are the metrics you're looking at? Like this will make this work, and this is how I know I could follow this model, and hit these things, hit these metrics, and still provide returns while keeping the optics strong. Like what do you, what's your focus?
Yeah, so we are, we're very focused in the Pacific Northwest, and we tend to go to places in a large sense where we are uniquely poised to add value to a given community. That usually means a lot of infill. That usually means finding, like adding density, adding spaces. It can take the form of, like we've been talking about here, doing like what we call park model conversion. So finding old RV spaces and adding park model homes to those communities. That involves a lot of utility upgrading. So we've developed some very cool utility solutions that involve some like alternative energy stuff, and it's really, that's brand new. It's very exciting. We haven't kind of like, but essentially like out in the Northwest, the data center boom out here is like consuming all available utilities. So we've had to develop some other strategies to kind of add, because one of the big things about
you can't just drop this, you can't drop this nugget without I'm peeling this onion a little bit. Like what kind of what are you doing on this to kind of get some additional utilities infrastructure?
Yeah, so quickly, the difference between so all the old RV parks usually have 30 amp connections, which is a 120, just like the outlet in your house, right? It's called a 120 volt electric connection, which is a single, which is for lack of a better term, it's a low-ish, it's sort of, if you think about like voltage as sort of water pressure, it's a sort of a low pressure connection. Modern RV sites have what's called a 50 amp connection, which is a 220 volt. So again, much higher pressure. The problem is, if you have a RV park with all 30 amp connections, you need to step up, right? You need to increase the available pressure to those sites. And oftentimes there's just not there. The utility is not going to spend a lot of time or effort to upgrade a transformer in a rural location. So we have some parks in a place called Hermiston, Oregon, which is like the epicenter of the data center boom. So it's great because, growing all sorts of awesome stuff, all the great metrics you want to see from a real estate standpoint, but logistically, we cannot get our transformers upgraded because the data centers are taking up all the time from the utilities. So what we found is we've been able to develop essentially a battery storage module for RV spaces where we can take a 30 amp and on our own step it up to a 50 amp connection. So it's stuff like that is sort of fun to develop, but you need to you got to do a lot of testing, you got to do a lot of other stuff, but it's one of those things where for us now, we can look at that 30 amp park and we can take complete control of all the upgrading that needs to happen there and not be like, oh man, I hope the utility upgrades this transformer for us at some point. So we look for opportunities like that what can we uniquely do to this property, increase the value? We find that even sort of in the Pacific Northwest is a pretty gigantic place when you start to understand it, where we have massive amounts of deal volume just based on what's here in our little region. And also just like this new legislative impacts has scared a lot of people with good reason. But I think that's created some really great buying opportunities for us as well, because instead of having a whole bunch of competition, this new regulatory environment has scared a lot of people. So now, we're one of the fewer, we're a smaller buying pool, I guess, which is obviously helpful on the buying side.
Great. Now, last question I'm going to ask you here, because I think you've got a great vantage point with your experience and the way you're still hands-on into the space. As you look forward, obviously the manufactured housing space, mobile home park investing, whatever the case may be, has gotten a lot of attention from investors, private equity looking to push further into the space. What do you see going forward? If you were looking forward, and we're talking at this just as in 2026, the beginning of 2026, what do you see over the next 12 months being a trend or something that you're really focused on in the space on a macro level?
I think from a, not to get like too high level, because that's sort of speaking outside of my expertise, but I think the next 12 to 18 months, particularly in the Pacific Northwest, but probably in other places as well, the amount of, well, let me just speak to the Northwest, which like I said, that sort of flight of buyers. We saw this in 2019 too, where people got freaked out. Oregon passed the first statewide rent control. Everybody left. And then 18 months later, they all kind of saw the sky wasn't falling. And so those same buyers, which is largely the private, and I'm trying to be magnanimous about like private equity and things like that. There's good and bad. But one of the things that private equity does is they have to be a little more reactive, right, versus proactive, because they're responding to their group of institutional limited partners who are like, what are you doing? Stop. They have a lot more like optical risk than like you and I do. So they leave when there's regulatory risk, because their limited partners say like, no, we don't want anything to do with that. And then 18 months later, they say, hey, this actually isn't so bad. Everybody seems to be doing okay. So they come back. So to me, in this region, the next 18 months creates a very unique opportunity where you have a lack of buyers, and then those guys are going to come back. So that's something that we find that you can't really control that. The other big thing is kind of, we've been talking around this, but like when you do these things, when you swap out RV sites for park models, when you upgrade power, it changes the characteristic of the property. And that's great for community building. But the other thing is that's great from a lending standpoint too, right? Because if you can, as you know, like that RV density is very important when you're looking at like agency level financing, so as you change the fundamental characteristics of a park, you're also changing your available lenders. And just like buyers, the more lenders that are willing to lend on a property, the better terms you're going to get. So a big focus for us is we do a lot of what you're saying. We buy a lot of non-institutional properties. We also change them to the point that they are institutional properties. And that's a really finding out different ways to do that. So like this RV power upgrade thing we've been working on, that's one example. There's a lot of different ways to do that. But so I think that's something we've had some success with. It's one of those unique places too, where you don't have to do a lot of rent increases to have very, very disproportionate returns. Because if you're adding density, if you're buying something at a 7 cap and you don't change anything except for the perspective, and now you have an agency qualified park, we can talk about how much lower that interest rate's going to be and how much better those terms are going to be, but we can agree they're going to be better. So I think that's one of the characteristic changes you can make, is you can continually modify that's what we focus on now, is like, how do we change the characteristics such that we can impact the value, like sort of independent of the revenue. And if you can do that, there's a lot of there's a lot of really cool opportunities where if you can sort of decouple revenue and value of a property, you're in a really good spot. And you have to do that here, right? Because you're going to have that, you're fundamentally limited on your revenue increases. But again, sometimes if you look at it the right way, unlike, look at like Travis County, Texas, where Austin is, their rents went down 20% because they're really good at bringing housing onto the market, right?
Yeah.
So like, from an affordable housing standpoint, good on them. If you're owning parks in Travis County, man, that's tough. It's tough to underwrite a 20% hit when I'm sure a lot of those guys were assuming rents are going to keep going up. In the Northwest or the Northeast or California, you can kind of set your watch to rent increases because you know what they're going to be. So that's not that I let me be clear. I don't think rent control is a good solution, but there are some sort of unforeseen advantages when you're looking at it from an investment standpoint.
Yeah, and I think going forward, even in this year, I think a lot of markets, I think rents have kind of hit a peak a little bit. They have to at least plateau. And I think if you're operating, you have to figure out how to operate inside of that box, creating some additional value, whether that's adding density, figuring out how to enhance some services along the way, and to infill those communities, which is so key. Listen, Andrew, you are a wealth of knowledge and information on the space, and you talk very well rounded about a lot of things that are happening. People have want more information from you. They want to, if they have a question about what investing is in the Pacific Northwest, how would they reach out to you?
Just, if LinkedIn's great. And then if you just go to the website's just bridgeviewassetmanagement.com. Those are easy places to reach me. And I love talking about this stuff. And I think we, hopefully that kind of came across about like, this is a great asset class. It's great for investment, but it also has a tremendous amount of promise for really delivering impact in affordable housing. And I think that's, hopefully we can kind of continue to get that message out there, because I really think it can do, and we didn't really get into like affordable home ownership, which is the other thing manufactured housing can unequivocally do better than anyone else. Where if you have someone who is, again, spending that $1,500 a month, and after 5 years, we did an analysis of this. And so if you look in the Northwest, if you rent an apartment in Portland versus buy a single wide mobile home, at the end of 5 years, the wealth discrepancy of those two people is $65,000, which if you're talking about someone making $17 an hour, that's life-changing, transformative wealth. And the fact is, like, you can't do that with apartments. So there's a lot that manufactured housing can offer, and hopefully that message will get out there too.
Yeah, that's a great point, because it's the stigma that people have about the manufactured housing space. And the reality is, if you look at the homeowners in your park, as it's a partnership. If we do our job well, those homeowners are going to have equity and have the ability to sell that home like any other homeowner would, with value that they'll be able to recapture. But for us to do that, we have to run our community well, which obviously takes capital to do it. Hiring professional management, and I'm going to, but the days of just hiring somebody to be a sheriff at your community are over, giving them free lot rent and maybe, a couple $100 a month. I mean, having professional management, instilling culture, that cadence, it all takes time, requires an investment to be made by the operator. You've done it.
You mentioned stigma, and I just quickly, every person that sort of like jokes about, oh, wobbly box mobile home, oh my God, I can't believe you live in a trailer park, trailer trash. Like, it's all in the ethos of our country. And I just want people to understand that's really damaging. It's really destructive when you say that, because someone is listening. Some 18-year-old kid is listening to you, and he's saying, I don't want to be trailer trash. I don't want to be a mobile home. I don't want to be that thing that you're talking about and laughing about. And when you do that, now that kid doesn't have that choice, and that kid can't live for 5 years in that manufactured home and build that $65,000 worth of wealth. So it's like, it's not, I'm not trying to be like a social justice person here, but like when you say things like that, and this is on people who aren't guys like you who understand the industry, but like it really hurts people. It legitimately hurts people when you try and make jokes about mobile homes and trailer trash and all this stuff. Like we have to get away from that. That is to me, if there's one thing that we can get out to the greater community, it's that. Stop making jokes about this, because if you legitimately want people to have affordable housing, you have got to understand that allowing people to build wealth instead of just paying rent is the most critical element of that.
Absolutely. That's a great point. So I've gotten a lot of value out of this episode, and I'm going to ask you listening if you've gotten value out of this episode, and if you would be willing to help someone you don't know find the next real estate deal, find out how to operate it or fund it, then I'm going to ask you to do one thing. Just give us a rating on the streaming platform that you're listening to this episode. That's how we get this message out to other people. That's how we share what's going on in the manufactured housing space and how real estate investing could be impactful to you. This has been Frank Rizzo from the MHP Exchange. Until next time, everyone, happy investing.